All right, and welcome. Here we are on the Investor Circle series, episode 7, with Ed from SFC. Ed, so great to have you here. I think you're live from London today, aren't you?
Yeah, absolutely. Nice to be here. Thank you for having me, Stuart. Yeah, absolutely. I am live from London in our office in Chancery Lane, currently sitting in one of the phone booths.
Fantastic. So, for those people that don't know, what is SFC and what is the thesis that you guys work to?
Yeah, okay. So SFC Capital, on a high level, we're an early stage fund, and we specifically invest through SEIS and EIS, which is a UK-based tax scheme that essentially, on a very high level, if you aren't aware of them, is essentially the government giving tax relief on an investor's investment into certain companies, and those companies need to meet certain criteria. And there is, a relatively long list, but on a very high level, it's for the SEIS side of things, it's the company can't have been trading for more than 3 years, and can't have gross assets of over 300k. There are other little criteria around, and I think if you're not familiar with them and you're looking to raise in the UK, I certainly would recommend researching it. Just type in SEIS into Google, because it's a fantastic way to raise money in the UK, and obviously I think it's one of the most attractive schemes in the world, really, for investors. So it does make it a really good early stage ecosystem. So yeah, we obviously specialize in that, SEIS and EIS, which is the slightly later stage for later stage companies. The tax and the company mature, but it's essentially part of the same scheme. So any company that comes to us, has to be eligible for those schemes. And specifically, we will invest from the SEIS fund first, which is up to 250k. And then we will reinvest from the EIS fund as a follow-on fund. So we have the ability to follow on into our portfolio, which I think is a big advantage that we can offer.
That's huge.
Yeah, sadly, we can't reinvest it in all of them because we have so many now. We're closing in on about 500, I think, portfolio companies. But I would say probably 10% a year might receive follow-on funding from us every year. So, if you're doing well, hit your targets that you laid out when you previously invested, and there's a good shot you'll get follow-on from us. We don't specialize in a sector or a stage, so we are a generalist fund, and we will invest in everything from prototype, pitch deck, sometimes all the way through to revenue generating companies, and all the way from product companies such as a drinks company, all the way through to companies, the deep tech companies, IP heavy companies, such as a company that we did recently that's looking to transport icebergs from the Atlantic to the Middle East to provide drinking water.
It's a crazy diversity of stuff.
Yeah,
that's insane.
A real range, and very active. So do about 100 investments a year. So making us the most active, I think, in the UK, at least, maybe not, if not Europe, by number of deals, and then about 20 follow-on investments into existing portfolio companies. That's all that's in a nutshell.
I mean, trying to deal with 100 investments a year, how big is the team?
Yeah, so the team is about 10 of us full time, and obviously everyone's got their own roles when it comes to getting a deal, from that first meeting all the way through to closing it. We have various team members that are involved in various parts of those process. So, my job specifically is on the deal flow side. So I'm responsible for going out, finding the companies, meeting them, and then, deciding which ones I think have got a good shot at the investment committee to receive investment. Then we've got a financial analyst who does all the DD, which is the next stage following the meetings. And then, we've obviously got the investment committee that, ultimately makes a decision. We present them with a memo, essentially, just like, most other funds, I'm sure. And then obviously we've got, a law firm that we use, to draft the paperwork. We do the majority of deals lead the round. So we would always like to try and, put our documents in place as at least the starting point, and then we obviously work from those templates.
Yeah, you guys, from what I remember, like to be the first check, right?
Well, I mean, obviously, we have to be, obviously, as SEIS is typically the first money a company's raised. It's the first money a company raises. So by definition, we are typically one of the first investors in. They might have had a bit of money from their own pocket, or their friends and family sort of type network investment a little bit before, but we're typically the first sizable check into the companies we invest in. Absolutely. We've got a process, really efficient process, I think, which we need to do to close 100 investments a year. And the time from a first meeting to close is 6 weeks is what we target. We can close deals in a week, right? The process is is designed in a way that we can get everything covered, do everything above, as it needs to be done, and cover everything that we need, and get deals closed. It's not often us. That's the problem. It's often companies not providing us with the information we need promptly. Enough side sometimes takes time, I'll be honest. But you do get companies that provide the information like that, and just are happy to go with the offer that's put on the table. Those are the dream types of companies, if I'm being honest. The ones that proactive, responsive, are able to make their own mind up, but take advice on board, and ultimately just want to get the deal closed, get the money in the bank, and get running.
Well, I have to say, I mean, we met when I was doing what we call a reverse due diligence call on behalf of a set squared company, just to find out more about SFC. And well, up until that point, I'd never really considered putting companies towards a fund like yours or SFC specifically, although I'd heard of people doing it. But actually, the things you're talking about with the efficient process and stuff, it really struck me as quite special. And I particularly honed in on some of the guidance that you guys give afterwards around taking on a non-exec for your board when you get the money and that stuff.
Yeah.
I was really impressed with like the efficiency of the due diligence process and the way you were able to provide term sheets so quickly to companies that you really believed in, and then get that process moving. And I've since recommended maybe 5 or 6 companies that come to you, and a couple of them have received funding, and the process has been super cool. I've really appreciated that it's done the job that it's there to do. The founders have been relieved by the process rather than felt burdened by the process, which has been really good, and the money has then been put to good use. So I've been really actually very impressed with everything that SFC has done so far.
No, fantastic. That's good to hear. But we like to think we're sort of no nonsense, get it done.
All tech companies though, no icebergs from
yeah, of course.
Really got to look up that company. That's so interesting.
NAS, North Atlantic Research Society, I think it's called. Check it out. It's pretty incredible what they do.
So most of the Canopy people are doing some sort of technology-based company. So could I just ask, what's the sweet spot? What's the perfect looking applicant from your perspective?
Yeah, I mean, that's a big question, and everyone's got their own opinions, right, on what criteria they need. We have developed a sort of in-house proprietary scoring mechanism based on 10 years of doing this, and identifying, which companies that have done well, what the common characteristics are, and we sort of transpose that into a scoring mechanism. It's out of 60, and a company needs to achieve a certain score to make it through the first stage, to even get to the evaluation stage. We score them, and if they get above a certain score, based on all the different data points that we use, which I think is about 25 individual data points, which adds up to 60. If they get above a certain score, then they get through. So it's broadly separated into categories. So it is we have a people category, attraction category, a market exit potential category, and then a few other sort of categories. And what we're looking for really is at the early stage. Obviously we are we do accept that typically at the early stage we're not expecting companies to have trading history and traction in the conventional sense, sales, licenses, recurring revenues. Obviously, if they do have that, fantastic. Obviously that's they get lots of points for traction. Obviously, if they're in a position to have got to a point where they're selling the product without having raised much money previously, that's obviously fantastic. But typically, the stage that we invest at, the majority of them are going to be early, pre-revenue, if I'm being honest. So it's we really place a huge amount of emphasis on the team. I know a lot of funds, that's a pretty standard answer. That's the team, and what makes a good team. Again, that's a difficult, and an age-old question. We like to see. We have a preference for co-founding teams. So, we do sole founders, but, we do have a preference for co-founders, multiple members on the management team, with a nice, combination of skills across the team. So we like to have, technical, commercial, operations, all covered in the team. So obviously it's no use if we've got 3 co-founders, but they've all got the same background, right? And then, we like to have seen them having committed to the business, or at least going to commit. Just a point. If an investor ever asked you, are you full-time or are you going full-time? The answer is always yes.
It's amazing how people get a bit vague at that.
And don't take any time to even consider it. Even a pause of a second, that could be a deal breaker. I appreciate you might not be full-time a business, at the early stage, they might not be full-time straight away, but as part of the round, the answer should always be yes, we're going in this full-time, right? You can't have a situation where investors are investing and you're still got 1 foot in, 1 foot out. Ideally, you'd already be, fully in, but I appreciate everyone's got to pay the bills, right? So, until you've got funding in the company, I appreciate not everyone can survive to do that. But yeah, full-time, again, on reasonable salary expectations, a sensitive subject because everyone's got different different lifestyles, but don't take the don't.
You're not looking to put 250k in to watch it all walk out.
Yeah, exactly. Don't obviously be reasonable. Base it on the financial position of the company and the raise, and be reasonable. And then again, that is a red flag if the investment, if the salaries are too high, then that is a red flag for us personally, and can be a deal breaker. And then we obviously like to have founders that have previous experience of running a company. That's obviously another positive thing. And then we're moving into the product. Again, as I said, doesn't necessarily have to be selling the product, but we do like to see evidence of something having been built, something tangible, something functioning that you're able to demonstrate not just to us as investors, but also to potential customers. And it's good
to work out how that goes with icebergs. I'm not quite
sure. No. Well, I think obviously we're talking about software companies here. I think probably when it comes to the stage of the product, IP, deep tech stuff, we're obviously happy to invest on a pitch deck, on a prototype at that stage, because we appreciate the value of the IP. But when it's a software, sort of more straightforward software stuff, we do like to see evidence, like an MVP, and that also shows that the founders put some skin in the game, either through their own money or their own time to get the product there. What we don't typically like to see is when you break down the use of funds, over half of it ideally shouldn't be going on the product. Ideally half of it should be available operational expenditure, working capital, basically to start selling the product and bringing on the team around that. So that's again quite a rudimentary way of looking at it, and it's not a hard and fast rule, but that to break down, that's how we like it. And then then it comes to market. We're quite broad with the market analysis that we do. We just are quite we segment it into software, fintech, insurtech. And that's typically how we look at the market analysis. And obviously there's certain sectors that we want to get more exposure to at the moment. And I can give you the usual buzzwords, but you would have heard them a million times before. AI, machine learning, fintech, or less so now. Doing a lot of green focused stuff, again, massively broad sector. But that's how we sort of look at it. And we're doing quite a lot of med tech stuff at the moment. And then we're going into the sort of the specifics of the round. So we like to see co-investment. So we like it when companies bring other investors alongside us, for obvious reasons, de-risks it, but also shows that you're able to raise money outside of just our network. And we like...
That's a really interesting point. I mean, in terms of the 250, how much of the 250 ticket do you want? Because that's the maximum under SEIS.
Yeah. So we can take the full 250, but we're always happy to reduce that down and leave maybe 50 to 100k available for their own investors then from their network. Obviously, SEIS is the most attractive, so it goes the quickest, and everyone always wants a piece of the SEIS, right? Because it's better for the tax relief for the investors. So we would typically probably do maybe like 150 to 200k from our fund, and then they could raise the balance from their network if they've got any. We also have an angel network, so we have our own funds that we manage on behalf of investors, but we have an angel network as well, which is a bunch of about 500 plus active investors that would rather be more discretionary in their investment approach. So they pick and choose their preferred options from the fund. And so that's the way, when we do all the heavy lifting essentially from the fund, all the DD, get all the paperwork in place and then promote it to the network, and they'll then pick and choose which ones they like the look of. And then that way we can actually increase the amount of money we can bring to the table beyond the 250 limit, even because some of them are non-SEIS, EIS investors. So actually I would say on average we're looking at 100 to about 300k we can bring to a round. And then valuation, again, a real tough, massive subject, but often a big sticking point, or which the valuation is what takes up the majority of the negotiation, arriving at one. Very difficult at the early stage to value a business for obvious reasons. There's not much data to go off.
Well, especially if they're pre-revenue, right?
Pre-revenue, right? And even early revenues, you can't really be applying all these sort of discounted cash flow models or multiples to that, because the revenues haven't been consistent enough, to be honest. So we like to take a bottom-up approach. obviously we want to arrive at a fair number for both parties. Don't want to take too much of the company that you kill it from day one, in the sense that you over dilute the founders, but at the same time we need to have enough of a stake that mitigates the impact of dilution that we are going to take as early stage investors. And it is crazy how much dilution you can take. Recent example of, we sort of started at sort of 17%, and now we're down to like 1 or 2%. So wow. It's so important to get that starting position right. So yeah, we typically say sort of 10 to 20% on the round is what founders should have in mind when going out and raising their initial rounds. And then
so you're doing 150 to 250k for 10 to 20%.
Exactly, yeah.
And you're trying to be the first check, the early check going in.
Yeah. So, but if it's a 500k round, we do 250 and they bring another 250, then that's obviously 10-20% of that. If you go 20%, it's 2 million. But yeah, if it's just 150, the valuation obviously is determined by the round size as well. So that's obviously another motivation for the company to go out and raise further funds as part of the round. But at the same time, another issue of that is that when you say that to founders, often they already start off wanting to raise a large round for obvious reasons. The more money, the better. But the more you raise, the longer it's going to take, and the more complicated it becomes. The more investors you bring in, the more complicated it becomes actually closing it from a practical point of view. And the longer it takes, and the longer it's taking, the more it's distracting you from getting on and growing the business and achieving, grabbing that market share, which the opportunity might have gone in 6 months. So you need to balance the need to get cash in quickly and just get moving with the need to have a decent amount of cash to give you a decent runway. So there's a balance there, and I would always be flexible as a founder. If you do set yourself to a number, don't necessarily have to stick to it. If you're finding it's taking too long, have a couple of different scenarios in your head in terms of the round size that you want and what milestones could be achieved with that, and then use that to be flexible.
Do you know what, Ed? It's really interesting you say that. I'm so supportive of that, because it's one of the reasons that I recommended some of the companies come to SFC, which is like, you can work really quickly with SFC to put this kind of money in place and get on with what you're trying to do. But you can spend 6 more months trying to work out what you're going to do and how you're going to get the money, and then you're going to miss the boat. So yeah, it's really interesting. Thank you for sharing that.
No, so that's fine. No worries.
So one of the questions that comes up in our community a lot is from foreign companies, particularly Portuguese ones, looking at the SEIS stuff and wondering if it's possible to raise money in the UK under that tax regimen. Can it be done, and can it be done with SFC? Yeah,
absolutely, it can be done. There are, again, specific rules and requirements around the way you structure it. That again, I would advise companies to do their own research and to seek legal advice on this, of which there are plenty of lawyers that will do it. We have a law firm that we have used multiple times to do exactly that when a company is based in Europe or the States or elsewhere. They basically just essentially, on a high level, they need to open up obviously a company here, a branch, either a subsidiary or a holding company, and they need to have a permanent presence in the UK. I think one of the directors would need to be based in the UK. But so long as that's the case, absolutely they can open up an entity here in the UK. Potentially employ a director who's based in the UK if they know of one, and then they would be eligible for SEIS and from us as well. As I said, we've done several companies structured in that way. We did a really great one from the business was originally based in Turkey. Two sisters actually, focusing on the e-commerce sector, and they got I think they got part of the global talent visa, which is run by the government, moved over to the UK. Opened up a company here, structured it in the right way, and we made an SEIS investment. So they've got a subsidiary in Turkey, and actually there was a Turkish fund invested as well alongside us, and a German fund. So it's a real pan-European round that, fantastic, lots of great companies.
Amazing.
Yeah,
amazing, because you say this SEIS stuff is world class, right? It's one of the best regimens in the world for raising
absolutely money. So no, 100%. It's very possible, and I would recommend it.
Okay, so I mean, Ed, for people listening to this, they're probably wondering, what's your background? How on earth do you end up being like an investment manager at SFC? Did you go to university? Have you done this before? Or was this just a first time gig for you?
Yeah, no, I think it's it's not the most usual background story. I don't actually really ever intend to get into it, if I'm being honest. Yeah, I did university and all that. I did economics university. Not that I think that's been much use, but anyway, that's a different story. And then I went into lobbying, public affairs. Didn't really enjoy that, and then moved into work for a credit ratings agency doing credit ratings on government debt, which was enjoyable from a sort of macro perspective, and that obviously gave me sort of an awareness of trends, etc. But it was pretty data heavy, quite a lot of spreadsheets, and then obviously I started actually doing a bit of angel investing myself through the SEIS schemes, as I'd heard of them. So I thought, why not? And that's
were you doing that directly, or were you doing that through things like Crowdcube or Seeders?
Yeah, Crowdcube and Seeders and stuff. Yeah. And then I heard of SFC, obviously through that, reached out to them, as a potential investor. And then obviously we have we have a program of a sort of scouting program, right? So, if you ever have a good business that you think would be, a good fit for us, you can send it to us. And if we invest, we pay a success fee. And they recommended I do that. And I sent them a few businesses. And off the back of that, I think we got invested in a couple, and they were like, well, obviously you've got some sort of eye for this. Do you want to maybe come on full time? Position just opened up. This was about 3 years ago. And I said I wasn't actually. I said absolutely, I'll give it a go. Looks really interesting. And here I am today. So we obviously do a lot of assessment of the financials as part of the DD. But a large part of it is also what you think of the team and what you make of the people, right? And that's less sort of quantitative, and it's quite a qualitative stuff, right? It's the feeling you get almost, and it's very difficult to describe what the right feeling should be, but you do just get more and more of an understanding of which founders you think are going to be able to ultimately get on with it and execute on the vision and be a success. And my job is really to try and identify those, trying to separate those from the ones that probably aren't going to make it. Sadly, there's no specific calculation you can do to identify those, but you just need to get a feeling. We do like psychometric testing and stuff as part of the due diligence, so we place some weight on that, so we try and be objective from that side of things. But there's also there's sort of the ability of the founders to sort of the way they communicate, the way they behave. Do they take on do they have that characteristic of I know what I'm doing, I can get this done, arrogance in a way, but not so arrogant that they don't take any feedback on board. So they need arrogance and humility. And
that's a dangerous combination.
Yeah, and those two characteristics are obviously quite contradictory, right? So it's very difficult to find a founder that has those characteristics. But if I look through our portfolio of 400-500 companies, those that are doing well, of which we have plenty, the overarching one common characteristic would be that they are superstars and they get shit done. They get stuff done really quickly, but at the same time they listen to all parties and take the feedback on board. They might not do anything with it, but they listen to it, at least incorporate it into their decision, and then they make a decision and they get it done and they execute. So I think it is quite clear that those are what you want.
Super interesting. We've got a really geeky saying that we have in the coaching and mentoring side of Canopy, which is it's an old joke, so it's a dad joke. I apologize for this, which is how many psychiatrists does it take to change a light bulb? The answer is one, but the light bulb has to want to change.
The
mentoring and coaching, we're like, if you're a founder that really wants to do something, we can help you. But if you're just going to sit there and say, oh, I don't want to do that, or this doesn't make any sense to me, or whatever, we can't get you anywhere. So we're looking for those light bulb people all the time.
100%. I totally agree. So
what's the joy for you, Ed? What's the joy in being like doing this investment stuff? What makes you smile every day?
I mean, we do a lot of deals, right? So we close 100 deals, so I'm seeing a large amount of pitch decks. I think between me and my colleague who work on the sourcing side, we're looking at 3,000-4,000 decks a year probably.
That's insane, man. How do you even
so there can be deck fatigue, and there can be fatigue sometimes just listening to people's businesses the whole time, but that said, when you get a good business and you really you get passionate founder who's working on a really interesting idea or interesting market or solving a really interesting problem, then you get really excited about that deal, and then you really want to get that deal because it's competitive, right? The good deals are competitive, but it's exciting to meet a founder like that makes you excited and makes you want to close the deal and make the investment. And that is really exciting when you find a founder like that, and the chase starts and all that side of things. That's really exciting. And then ultimately seeing those companies go on and do well is obviously a fantastic feeling. Sadly, there are plenty of times where we've had fantastic companies and they've been fantastic businesses, but something just hasn't quite worked, or they've got unlucky, or something totally out of their control has happened, and actually they haven't gone on to achieve what they could have done, which is really sad, actually, because you know the potential of the team and the business, and but there's a vast amount of luck involved as well, as with everything in life. So that's always difficult to take. And then of course
you're at the stage where in this kind of investment round, it's probably 1 in 50 that have a chance of doing something really mega, right? And maybe 3 or 4 out of 50 are going to do something medium, but a huge proportion are going to ultimately fail at this particular level.
You're right. Those are the exact numbers. Yeah. And a failure isn't necessarily like a liquidation. It's like it just doesn't go on and hit the milestones and doesn't go on to get to the next stage that enables it to crack on. So yeah, you're absolutely right. But we're fully aware of the numbers, but every business we invest in, we start off thinking this does have a really good shot.
Absolutely, or you wouldn't do
well,
it, right?
That's the whole point of what we try and do. But yeah, as you said, anything can happen tomorrow, let alone in a year's time. So yeah, that's just the way the cookie crumbles, and that's why I think our volume approach is totally the right strategy for the early stage investing. I appreciate later stage when you're doing bigger tickets, you want to be more focused, but our overall thesis and strategy is volume, diversity, and quality. And yeah, as you say, if you get enough really good companies with good diversity across everything, the team, the sector, the market, the business model, then you've got a good shot at getting the returns at the end. And we are starting to see now the exits and returns coming through, which is great.
10 years, right? It's about the right time for
I think you've really got to expect 5 to 10, 5 at best, 10 probably more realistically, and we've been going for 10 years now. And interestingly, the initial funds which we launched 2012, I think 2013, they're now starting to mature and deliver the returns, and that's ultimately how long the returns period is. It's just the reality of it. And some investors don't realize that it takes that long.
But they get their tax relief when they put into the fund.
Yeah, right? Exactly. So you get your tax relief at, initially 50% back if it's SEIS and 30%. So yeah, and then then obviously then we try and aim to start returning money in them within after sort of 5 years.
Super interesting. I've got a couple that investments I made 10 years ago that I'm really hoping will pay out soon. One of them is it's actually Crowdcube, and a small stage investor in that itself as a platform.
Oh well, okay, really interesting.
So I knew the founders when they first began the project, and just really believed in them as people, so put a little bit in on
fantastic,
the second round actually. So who knows where that'll go this year. Let's see.
No, I think that's good. I think the one thing that the early stage investment in the UK maybe and probably globally is missing is the liquidity side, right? It's quite difficult to get your money out ultimately when it's in.
There's no secondary market really, right?
There are secondaries, but they lack the liquidity, really, don't they? That's the problem. So that's one thing that I think needs to be improved, and I think if you could improve that, I think it would just double, triple the amount of investment going into the space under these schemes, because if you can get your money out relatively easily after sort of the 3-year period, which is the minimum holding period you need to hold the shares for to retain the relief and all the benefits as well, because it's also capital gains free as well on the upside, no capital gains on any profit basically. So again, it's just fantastic, and if you can get a liquid secondary market, then you're away.
I don't know if you've seen it, and I won't go too much into this because this is about you and SFC, but there is a new fund that's just done its first version maybe 6 months ago, and it's one of the investment managers who left Crowdcube a while ago. And what he's done is founders put in a little bit of their equity from their companies into this little fund, and then they all get a return if anybody gets an exit.
Okay.
So it's a way of them getting some liquidity before their own exit.
Yes,
Really interesting model. So they all put like a couple of $100K into one. There's about 10 or 15 founders that do it into the same pool, and then they all kind of live a little bit of liquidity off of each other until they finally get their own exits from their own companies.
Oh wow, no, that's a very interesting concept. I like the sound of it.
That was quite innovative. Absolutely.
No, absolutely. No, that's what it's all about.
So look, this podcast and this conversation has been absolutely awesome. I really appreciate your time today, Ed. Thank you so much for this. And I wonder if you could close us out with like your top tip. You know, this is really for first time founders raising their first money. SFC and the SEIS is the absolute sweet spot. So what's your top tip for somebody who's looking to come to you for money?
No, it's a great question. I think it's probably around that point I mentioned earlier, which is, you know, being, you know, flexible with what you're after. You always have in mind different scenarios when it comes to the round and the raise, and, you know, gauge it on how the conversations are going with investors. Don't set yourself to one target and focus on that incessantly, and then, you know, end up maybe not raising it and basically just giving up. Whereas, you know, I think cash is king at the early stage. So, you know, I think you need to prioritize getting cash into the business so you can get moving, build out the product, start building out the sales, getting the traction that will enable you then to go and raise, you know, the larger rounds of, you know, £1 million plus rounds, which you might read stories in the paper about £1 million rounds for startups at the early stage with pre-revenue, but those are the exception. Those are the ones that are publicized. What you don't read about is the, you know, hundreds of other deals that are done at, you know, 100 to 500k for the first round, at, you know, sort of at the 10-20% mark, and those are the majority of deals that are done at our stage. And if you fit yourself into that, then, you know, you've got a good shot of raising it, you know, relatively quickly. And as I said, then you've got the cash. Then it's about you just going on and executing on the business plan and the vision. And so, yeah, I would say be flexible and also be reasonable and be realistic. So, you know, be reasonable with your expectations and your sort of and the terms that you're demanding. And yeah, don't treat the investor as the enemy. But, you know, at the same time, you know, obviously you've got to be professional and fight for your end. And there's always going to be a bit of negotiating. Of course, we would expect that. But, you know, if you work with them, and yeah, I think, you know, you've got a good shot of raising the funds from someone like us.
It's really interesting, Ed. Thanks for that. I mean, in my head, I'm just hearing this phrase, you know, you can have 100% of nothing, or you can have 85% of something.
Exactly. Yeah, that's spot on. Yeah, that's spot on. That's exactly it. Yeah, that's the mindset you should have at the beginning. Yeah, don't be too possessive of your equity at this stage. You know, the valuation will take care of itself. If, you know, once you know, build the business up and get traction, then the valuation will take care of itself. That's when you'll start, and that's when you'll make the money. But, you know, you need the money, cash. You need cash to get there, right? And so, you know, you need the investors, so work with them, and yeah, it can be a really fruitful relationship for the both parties.
It's super interesting as well. I mean, a narrative that I've heard a few times recently is the point where you're raising money. You know, all these numbers come from all sorts of different algorithms and ways of thinking, but the moment you start actually making profit, it really level sets the whole valuation model, because there's some performance now to look at. So you're selling stories at this stage, right? You're selling stories really to the Series A stage, and then suddenly you get this readjustment, usually down, not up, in the valuation, and it becomes a real tangible thing.
Yes, exactly. Yeah,
actual performance, and that can be a really difficult phase to adjust to, right?
Yeah, no, that's exactly right. Yeah, no, you're spot on there as well. Yeah, selling the vision initially, and then you've got to prove it actually is viable, and that's what the late stage investors will need to see. You know, at the moment you've got a bit of flexibility with investors at our stage. We're happy to believe that you can execute on a vision and invest, as you said, in a plan. But later stage funds, they're going to 100% need to see a viable business model, and you need to get to there, and you've got one shot at it. So you need to be focused on it 100%. Gone are the days, I think, when you just keep on funding the business, the cash flow, basically. You know, it's become a lot tighter, especially at the later stage.
Yeah. Thank you so much for today, Ed. It's been absolutely brilliant to get your insights. I really appreciate it. And I hope everybody listening to the podcast really appreciates just how gold some of your insights have been today. Thank you so much.
Great, Stuart. Well, thank you for having me. Really enjoyed it.